All right, well, welcome everyone to our Question of the Day series. Today, we're excited to have on the line with us Joel Wilsford, our Managing Director down in Atlanta, Georgia. Again, this is Kurt Nadevelt, the CEO of Rainstar Capital Group. And Joel, I want to welcome you to the presentation today. How you doing?
I'm doing well, Kurt. Thank you for inviting me.
Excellent, excellent. So today we're going to be going through and discussing what we call our debt discovery process, right, Joel? Going through when you meet a client, and what are just kind of some of the initial things that we need to know, to help that client, in securing financing. So when let's say you were to meet me or you to meet a new client, whether it be a referral from one of our partners or whatever. What are some of the first things that you need to know to see if we can, secure them financing, through our platform of over, 200 registered lenders?
A lot of it depends on the particular transaction, but probably the first thing we need to know is if they're looking like for an equipment loan or an equipment lease, looking to buy some equipment, whether it's a loan or a lease. We need to know, do they have the capital to satisfy the down payment requirements? The equipment they're purchasing could have a requirement of 10 to 30% down, and we just need to know that they've got that available to them. If they don't have it available, then we're sort of between the rock and the hard place of moving forward. We really can't get them financed unless they've got that. It'd be the same for real estate. I think almost everybody understands that when you're going out to buy a piece of commercial real estate, an office building or a small, say, convenience store or a small apartment complex or hotel, motel, you're going to have some capital down in order to do that. And that'll range depending on a number of factors. That could be as little as 15% and as much as 35, 40%. And so that's the first thing that we typically want to know. Do you have the capital to sustain the transaction requirements in that? And then we're going to look for the next thing that we're going to look for is, what is your regular cash flow? Can you not only have the capital to initiate the transaction through the down payment, but do you have the capital to sustain the debt after you've acquired the collateral? Can you make the mortgage payments? Can you make the equipment loan payments? So we want to look at the cash flow, and that's why we, as in a previous edition, we talked about the need for income statements and balance sheets and the banking statements that we require from clients. And so we can evaluate what your cash flow is so that we can, structure the transaction. If you have seasonality, maybe you're a farmer, and so, and from October to May or March, you have low income. Well, we want to structure the debt so that your cash flow doesn't get impacted. So that means that there may be periods where you have a very small payment or no payment, and periods where you're going to have a much higher payment to be able to pay the debt properly. So those are just some of the things that we look at. Then obviously we look at your history in terms of how you've handled past debt, and we look at the value that this acquisition, this financing is going to bring to your business. Is it going to add value by allowing you to increase sales? Is it going to add value by letting you reduce your overall debt load by refinancing of some sort? So those are things that we look at to see if we can secure the financing for you. At the end of the day, we're looking to make sure that you have the appropriate capital to do the transaction, followed by enough capital to sustain the transaction. If those two things work, then we can probably figure out a way to get that done.
Yeah, excellent. Yeah, very well said, Joel. So good. Well, good. Thank you for addressing that question, and we'll be in touch soon. Have a good day.
Thank you, Kurt.
Yep. Wow.